Good afternoon.
Hi, Mike. How are you?
I'm doing well. How about yourself?
I'm doing well. I'm doing well.
Cool, cool, cool.
Uh,
So I didn't even pay attention to football this weekend other than the Packers barely won. Did your Cleveland Browns do anything good?
uh, no, statistically, yeah, they did a lot of things good, but yeah, when it matters, they still lost the game. So we statistically dominated the Falcons, but lost. So that's par for the course, I guess.
It ain't easy, man.
No, it's we jokingly say our head coach is 2-2 versus coaching against himself, where he likes to make things. He likes to do things the hard way. So
All right. Well, my alma mater, Wisconsin, their coach, he got fired this week.
yeah, that's. I think I read that he's getting $11 million, $11 million buyout if he takes it lump sum versus the 14 million owed to him. So not a bad way to go out if you're going to get fired.
I guess I should have learned more about football, maybe.
Yeah, no, and I think the guy taking over, Jim Leonard's a good guy. He was a phenomenal college player, awesome NFL player. So it's the only problem is you got to recruit and play against Michigan and Ohio State every year, and that's easier said than done.
This is true. When you have two stadiums that you put 110,000 people in, and they're absolutely nutty about the team, you've got some admirable adversaries for sure.
Yeah, no, it's the state of college football where it's easier said than done to kind of get it into that rarefied air to be in the upper echelon there.
Yeah. All right. Well, let's get on. Let's talk about lumber.
Yeah, lots going on here. We're sharing. We'll jump right in. The big takeaway with lumber, and we'll obviously get into this in greater detail. And you know what? I'll just instead of flipping through this, we'll kind of the obvious thing here is this massive increase again with the commodity funds. This is as of September 27th. So as of last Tuesday, you had another massive increase with commodity fund shorts plowing into this market. So you could see, look at commercial shorts. The mills are virtually non-existent.
Have you ever? I've never seen that low of a number.
No. This is, 4.7% of the open interest is unheard of. I mean, typically you would drop under 15%, 20%. That would be historically low. So this is an all-time low, continuing making all-time lows, and then this managed money, position staying above 60%. I think the high water mark's about 65 to 67%. That's kind of, the funds are more than happy to take the sawmill's place for the last $300-400 a thousand. And we know that at some point these guys get pushed to the sidelines. But to say that you're at that moment now, it's tough to see. Where you could definitely see some of the weak-handed shorts get pushed out, but it's tough to envision why they're not going to just roll into their November shorts into January at this point, given everything out there.
What also is kind of remarkable about that number is it's made up by 14 entities.
Yeah.
You look at the bottom. So on average, if it was perfectly uniform across the board, each one has on a little over 100, 110 contracts.
Yeah. And again, how many funds actually trade lumber? I can't imagine this number is greater than 20. So it's you've piqued the interest of probably the vast majority of funds that would even touch lumber futures, and they all want to be short, and everybody else, outside of the other obvious part here. Well, the cheaper you get, the more commercial long interest you get as far as covering forward type stuff. But this is just a massive number that continually grows and is definitely something to watch as we move along here. So kind of getting back into the big picture, the big thing that jumps out on this for me is last week, 10-year notes briefly touched 4%. So that was, you have to go back to 2010 type levels. Since then, we've seen a pretty decent pullback now. As of this morning, we are around 3.58%. So as rates kind of pulled back here, it's been a good catalyst for a rally in equities and a rally in commodities. We'll kind of get into kind of why we're rallying. I think it's a little bit more than interest rates, but something to watch. And then let me flip forward here. So yeah, it's as of this morning, we were 3.5, 3.60%.
We
Did I
lost you.
unshare?
You unshared on accident
Okay.
there.
Hang on 1 second here. Okay, there we go. Can you see that?
Oh, I got to turn you on. Sorry.
Yeah, there you go. So the 10 years pulled back to 3.6, but you can see as of last week, again, you touched you basically touched 4%. And the last time you touched 4% was back in 2010. And then see here, 30-year. I kind of did a hard look this morning, and I saw 30-year mortgage rates basically in the 6.75 to 7.03 area, where a vast majority were up in that high 6.9 something to 7% area. So you can make the case that the average person's probably going to pay right around 7% for 30-year mortgage rates. So you haven't seen that pullback you've seen in the short end of the yield curve materialize in 30-year mortgage rates here. You're still right in that 7% area.
Wow, that's just amazing.
So the headline today is, and we're still hanging on to gains here, but the S&P is up just under 6% in the first 2 trading days of October. So it's, the S&P on 500 on track for the best 2-day gain in 2 years. The flip side of this is going into the end of September, the S&P year to date was down just under 25%. Dow's down just over 21, just under 21%. NASDAQ's down 32%. There really is no flight to quality. Even oil, which has been high flying going into the end of Q3, was only up 5.7%. So it's just kind of interesting when I look at the rally in equities the last 2 days. To me, this is Q4 money allocation 101. You had everybody taking their lumps going into the end of Q3, and now you've got the start of Q4. So asset managers, money managers have to allocate money accordingly. And I think that's a big reason why you've got this ongoing rally in equities more so than anything fundamentally outside of a oversold condition. So I would be shocked if this has got legs or staying power outside of this is just Q4 money allocation taking place in equities here the last 2 days.
But if there is some certainty as to the end of the hike cycle, rate hike cycle, that's what everyone's looking for, is certainty.
Yeah, absolutely. And I'm a little skeptical. I'll play devil's advocate with that. The other thing that kind of job openings plunged by more than 1.1 million in August. So, what does that mean? You can see, this kind of lays out job openings finally have started to descend here. Unemployed workers, you're getting the convergence now. You're going to likely see more convergence between jobs available and unemployed workers. And this is by design. This is what the Fed wants. They want less job openings. They want more, I hate to say it, but they want more unemployed people to rein everything in here. This is part of the master plan as far as the Fed is concerned. And so, kind of flipping into the next big component, which is, I think, the real catalyst for what's going on, is pure and simple. Dollar topped out in the last week. Dollar tops out. Look at the rally in gold. Look at the rally in copper. Look at the rally in crude oil. And part of the crude oil we'll talk about is the expectation that OPEC's going to curtail here. They meet tomorrow, and there's a big expectation that they're going to have a curtailment. But dollar weakens, commodities, dollar denominated commodities get strong. You can see it on the charts. Dollar did give a sell signal here up in the 113.5 area. You close back under the Bollinger Band high. Again, I think this is just an over correction, more so than saying that the dollar's topped indefinitely here. I think this is just kind of catching its breath more than anything else. And so when you look at the US dollar versus all the other major currencies out there, I mean, this chart is all telling. You want to talk a bit about a visualization here. What's the US doing? Pure and simple, we're exporting, I'll repeat, I'm going to say this slowly. We're exporting our inflation to everywhere else.
Yeah.
I mean,
we're importing deflation.
Yeah. We're importing deflation. We're exporting our inflation. Everybody else deal with it, pure and simple. So what does this mean for commodities? Again, in the last 5 days, dollars down. So look at all the physical commodities and the returns over the last 5 trading days as the result of the dollar topping out. You've got silver, RBOB, platinum, palladium, crude oil, copper, Bitcoin, Goldman Sachs Commodity Index. When you look at Q3 winners, natural gas. These are the big Q3 performing commodities. More so than fixating on the winners. This is year to date. Heating oil, nat gas, heating oil. Really, the losers jump out here, and unfortunately, there's our lumber. So Q3 losers, lumber's top 3, down 36% for the quarter. Gold's the other big one that's a surprise, down 7.83%. Year-to-date losers, lumber's leading the chart here again. You want to talk about the canary in the coal mine, the leader to the upside. Well, we're also the leader to the downside, unfortunately, year-to-date here. And so this kind of shifting back into OPEC, given the idea that there's demand destruction out there. They meet tomorrow, and the expectation is that they're going to have their largest curtailment since 2020, since the onset of the pandemic in 2020. And so I thought it was interesting. Goldman Sachs said today that OPEC's power is at an all-time high, and the old oil order is back. And I've got friends, and I had a buddy tell me this in the Portland area today. He filled up his Suburban. Oil prices are back above $5. Unleaded gas prices are back above $5. It cost him, I think, to put. I think it was like middle of the road. It was something like $153 to fill up a Suburban today. So this is something to watch. If OPEC does anything meaningful as far as oil curtailments, this is the last thing the Federal Reserve wants to see. This is the last thing the current administration wants to see, especially going into elections here. Where can you honestly say that inflation's in check if oil prices, and the reason I'm bringing this up, just 62% retracement in front month crude oil takes you back up to the $95 to $100 area after being sub $80 here. If you do get this move technically back to $90 to $100 here, that's not a good look from an inflation standpoint. It's not a good look to say that. To me, the markets want to rally that inflation's under control, the Fed's doing the heavy lifting. You want to talk about throwing a wrench in the works if oil goes back to $95 to $100, given the idea of a global recession. This is just, again, something else to watch. And, the last thing I'll add here is, what's our government going to do in drawing down their strategic reserves? You can see that when are you going to rebuild our strategic reserves? Are you going to wait now? Do you have to chase this strength? So there's a lot of balls in the air once again. With the one commodity outside of lumber that we thought inflation was in check, was under control. It'll be interesting to see if unleaded gas prices start to go back above $4, $4.50 nationally. what kind of pressure that presents, and that's something certainly to watch tomorrow with OPEC's announcement.
There's no doubt if there's one commodity that hits everybody across the board, it is gasoline.
Yeah, yeah. And we'll kind of get into housing. And I saw Matt's question: what will lumber lead? What will a lumber lead look like to the upside? I'm sorry, what will lumber, if it leads to the upside, what will that look like? And we'll kind of get into the technical type numbers. But just quickly with housing, I don't have that much stuff, but you can see, again, the beneficiary of the single family destruction is the multi, and you can see how multi is growing. These are the different, the red is the United States, and then the different regions. You can see how, again, single family is down everywhere at the, kind of helping the multifamily push higher. Housing in the news, U.S. pending home sales last week. You can see the only area that had any type of growth was out west. Everything else was still down month over month, still down year over year. And then I thought this was great. Loan to value, multifamily loan to value ratios are at multi-decade lows. So if you're a bank or you're a lender, the lower this number goes, the less riskier these investments are. So the multifamily component is going to surge ahead because there's less risk. As far as even with the increase in rates, because of valuation still being strong, this is deemed a less riskier investment area from a lending standpoint. So the multifamily component is going to continue to be fairly well insulated, and that's going to be the growth metric for starts here for the foreseeable future.
I saw an article. I'm just trying to find it real quick. Talking about investors going in and buying multiple houses from builders, like 10 houses at a time.
Yeah.
And they're doing it to rent them.
Yeah. No, it's amazing where the shift again is in the rental income. That's your free cash flow, is that monthly rental income. It's not necessarily the appreciation of the underlying asset. It's almost like the asset itself is secondary. It's like buying a dividend yielding stock where, okay, the stock's going to go up, it's going to go down, but it pays a dividend, and that's what I want. I want that dividend that's going to give me that annual or that monthly return, and that's kind of the multifamily model right now, and rightfully so. There's still a shortage of homes. So, what are the reasons? Housing in the news, reasons home contracts are falling through. I thought this was interesting. The big reasons: buyer backed out of a contract, mortgage application was declined, seller backed out of a contract. This is probably a function of, well, I have to go somewhere if I sell, and I can't find anywhere to go. And again, I know I probably sound negative when it comes to housing, especially the single family component. I think a 1.3, 1.4 housing starts number is still, historically speaking, a really good number.
Agreed.
It's just the issue is we're coming out of 1.6, 1.7 type numbers, and everybody had built up in the expectation that those numbers were not only achievable but sustainable. And that's the hard reset this industry is going through right now. That unrealistically is probably a 1.5 something. You're going to have to set your sights lower to 1.3, 1.4. And that's the struggle we're going to go through from a demand standpoint and resetting our expectations. So, this is the weekly continuation. We're still, and Matt, this goes back to Matt Lehman's question. If lumber is a leader, where can we conceivably go back to? And I'll let the technical and Mike jump in here with the technical analysis. I think you're obviously going to see it technically first in lumber futures. And so you can see you're still in this triangle coil formation, downsloping trending formation. On a continuation chart, you would really need to get back above I'm going to say the 470, 480 area for starters. And you'll see this on the daily, um, where,
Just going back to the continuation, the first thing, you look at that, the rate of decline has obviously slowed.
Yep.
And it's even more obvious in the next chart that the decline has essentially stopped for right now.
Yeah, and so you've also had a market kind of give a reversal back to the upside. You've got two competing channels here, this downsloping channel. I think at the very least, what I would look for as far as November, and November is still the lead contract here, and I'm going to pull up. I'm a huge fan of the 9-day moving average, and so what I would look for with November and January is consecutive daily closes back above the 9-day. The 9-day in November today comes in the 428.90 area. The last close above the 9-day, we did it for 2 days in a row back in September 20th to 21st. The market settled, tested the 9-day and then failed. And then you had another resumption, another leg lower. So consecutive daily closes above the 9-day begin to suggest that this market can get back to the Fibonacci retracements, this 472 to 513 area. But to say that you're going to go substantially higher above this 500 to 515 area, that's going to be a function of the commodity funds puking out of a bigger short position and seeing something dramatic happen in cash. And the issue I have when I look at futures right now, from what I'm hearing in cash, November is a 432. November traded up to 448. To me, the highs in November today at 448, I would tell you, you've had convergence. You should liquidate your November futures and go buy the physical cash. I mean, I'm hearing cash numbers conservatively in the 420 to 430 area. So the idea that November belongs at a premium, November, if we're bottoming, can trade at a premium to physical cash, but at some point it's going to have to stabilize and help cash form a bottom. And as much as I want to see that, I'm seeing zero indication that cash is anywhere near a bottom right now. I've heard low end numbers of in the 400 area, and I'm not even seeing volume or interest on the buy side to even buy volume at those numbers now.
Yep. Now, from a technical standpoint, the market back in August, that was what should have been support coming into the end of September, and we blew through that, right? So once you blow through the support and go below it, then it becomes resistance, overhead resistance on the way back up. So yeah, you're right. As we hit the 475 to 500 range, that's going to be resistance. If we go through that, it's going to be, I believe, what you said. It's going to be the commodity funds blowing out of their shorts that'll take us above there.
Yeah, and so the other thing, and the other thing I'll add is that on this rally here, the sawmills have been woefully lacking as far as selling this the entire way down. The one thing in BC as of the 1st of October, and I've gotten multiple confirmations on this, that as of October 1st, BC stumpage rates have come down. I'm getting variations anywhere from $45 a thousand to as high as $90 a thousand. Interestingly, when numbers move against the mills, they're very quick to tell you exactly how much they move against them. When they move in their favor, it gets a little bit more ambiguous. But anything that crosses scales starting October 1st, so what that means, anything that's been previously logged does not see any stumpage adjustment. Anything that's logged today that crosses scales today gets a significantly lower stumpage rate. So that helps lower cost of production for BC sawmills starting 10/1. That's in place. So you wonder how much that influences kind of the idea where all the expectations are that we're going to get more curtailments. We're going to get more curtailments. Are we there yet? And seeing is believing. I want to see the curtailments more so than just the assumption that more curtailments are ahead, because I think that, again, for me, the curtailments in British Columbia are more a function of log availability, the availability to build out log decks, than they are a cost of production type curtailment in BC. So again, you'll know the end is near, that you're truly getting into cost of production type numbers when you not only see, and we've stressed this the last couple of weeks, you need to see the curtailments not only come out of BC, but from other producing regions, Pacific Northwest, the East, even out places like Alberta that have a significantly lower cost of production. That's when you know you're truly impacting sawmills' bottom line and they can't live down there. But so far, I don't think we've gotten to that point where we've reached that breaking point for sawmills.
Well, it's on the horizon. When you have a sawmill like Canfor, announcing some curtailment. They had, obviously Canfor isn't curtailing because they think prices are ripping higher.
No, and that's kind of I'll mention this. We're collectively trying to push the CME to allow other people to deliver into futures outside of sawmills, meaning that if you own a sawmill's wood and it's in Chicago, a Chicago reload, then you should have the ability to deliver that wood. We think that would be the next logical step for this new contract, to where if the sawmills don't want to deliver their own wood, whether it's through EFPs or through actual delivery through the exchange, that would be the next step, is to get the CME to write this into the existing contract where anybody could deliver the wood. Now, you'd have to have a freshness date on the wood. It would have to be part of contract specifications, a number 2 stamp. It'd have to be in Chicago. There are some stipulations, but that's something that's being proposed and discussed within the CME now. And just so everybody's aware, that's how the mechanism works for grains, where the vast majority of grain EFPs and deliveries are not from the manufacturer, they're not from the farmer, they're from co-ops, they're from the middle market maker, more so than the actual farmer or producer of the grains.
So a couple of good questions here. I'm going to jump over Matt's. We'll come back to that one. But John Bavister from Iowa asking, what impact does the lower stumpage rate have on the CVD calculation? That's a good question.
I think it's a good question, and the mills all have their formulas. The difficulty with the CVD, the duties, is that the duties that are calculated off of today's numbers are 18 plus months out. So the duty calculations that went into effect recently are literally from that time frame of 18 plus months ago. So you're so far down like somebody anti-dumping today, the impact of that is probably 18 to 24 months out, or at least that's how it's been explained to me. So that's the difficulty. They all have their formulas. They all kind of anticipate what the duty will be. They all set that money aside. But in dealing with sawmills specifically domiciled in BC, you could talk to 3 different sawmills and, well, what's the duty mechanism? What's the duty trigger? Why are you selling here when your competition is priced up here? And you're going to get 3 different varying answers as to, well, wait a second, how come they don't want to sell because it triggers anti-dumping, whereas your direct competition in that same area is on the market way down here? Why aren't they factoring that into their equation? And so to each his own. I don't think that there's a clear uniform answer, because that duty, again, what's being calculated today, the real impact of that is 18 months plus away right now.
Trailing indicators. So
yeah.
If so, will that allow the mills to take their cash prices down quicker? I haven't seen a mill wanting to take their cash price down quicker. They take it down when the pile of wood outside is too big.
Yeah, and I think that's the biggest determining factor, is that can you continue to stack wood, wood's not going overseas. It's not flowing to China. You can only keep so much wood in Canada. So, especially as the big nationals begin to, you are seeing cancellations of contractual wood obligations. I know there was talk of that in Texas, but I'm starting to see that not specific to a geographical location. It seems to be more widespread now throughout North America and the U.S. So at what point, you either begin to move off your pile or you curtail, and that's kind of the obvious answer is we're heading into that area. It's just, how quickly do you get there? And I think, between the countervailing duty, the duties, and stumpage, I think stumpage is definitely something that's more impactful on an immediacy standpoint as far as lowering your cost of production. But how that transfers into the open market, you could ask 5 different mills and get 5 different answers. Trust me, because I have. So this goes back to Matt's, what does this mean for the short funds? The algos in my mind, and Mike, weigh in here. The algos are more day traders. They're not necessarily position traders. The commodity funds, when you look at those CFTC numbers, those are your position traders. So it's the commodity funds that are building this massive short position. They've had that short position probably since $700 to $800 a thousand, and have ridden it, rolled it all the way down. My expectation is they would do the same thing, roll their November position into January. But it's the commodity funds. Again, they could wake up one morning and walk outside and decide they don't want to have that short exposure. But to get to that point, I think you'd have to begin to see some kind of green shoots, some kind of light at the end of the tunnel that's positive concerning housing, more so than just blindly coming out of a position. So my expectation is they'll roll their November short position into Jan, and you can see how this spread traded down into the negative 23, 24 area. And once the Rogers long fun roll was out of the way last week, that spread immediately narrowed back into $10. So the expectation is this spread, just like the last 3 spreads, could go back at a minimum to even money, realistically 10 to 20 over for starters. As you get into, typically the 12th, the 15th of this month is when those short funds are going to seriously consider rolling their position into the end of the month. So, again, my expectation is November probably has more potential to the upside. January probably has more potential to the downside, in anticipation of knowing that there's this massive, we'll come back to all this, or we can, just looking at those CFTC numbers, 2/3 of this position is still in November. So that this position either has to get liquidated or rolled into January by the end of this month. That's what we know in lumber right now. That's the given, that they're not going to deliver. They will not deliver these November contracts. They'll be out of these by the end of the month.
So I'm just keeping my eye on the dollar.
Yep.
There are things that you can, from someone outside of the lumber industry, hang your hat on, that is just a fact. Strong dollar is going to attract wood from outside of the U.S. to the U.S., and that is going to be a bearish signal. I mean, that's going to put pressure on the prices here in the U.S. If the dollar stays strong, these people are right who are the managed money. If that dollar begins to weaken, the first people to know about that are the funds and the Wall Street type, financial traders. They will take that position off. So what does that mean for the spread? That means that you're going to get buoyancy, or a bullish move in November relative to January. So I can't see that Nov-Jan spread going out beyond where it's been. I think we saw, just watching the trade on that Rogers roll, the day one had the lowest prices.
Yeah, and it narrowed from that point. Yeah,
and then
so I think that's a great point, Mike. With kind of you just look at the euro versus the US dollar. I mean, this is huge as far as, no, you're going to continue to see, just from a dollars and cents standpoint, when you look at FX, I mean, look at the Canadian dollar, look at the euro, if you're just going to look at it from an FX standpoint, it's pretty obvious what you're doing with your wood right now.
Yep. All right, let's look at some basis kind of stuff.
Yeah, so from a basis standpoint, here's your, this is the legacy contract forward curve. And again, this
Pretty
is
normal.
as of yesterday's close. I mean, again, January did trade as high as 457.50 today. November traded as high as 448. So again, if you're in the market for the wood and you get November, January, you're still too far out from a timing standpoint. But if you get November trading at premiums to physical cash, and you get that convergence, then you're going to get interest to just liquidate the futures position and go buy the physical cash. And again, the whole idea of a basis trade is as you execute one side, you're immediately executing the other side. So that's something to watch for as well, especially with some of those, when we look at the CFTC longs here, there's a lot of basis longs in this market, forward longs. So if November, okay, we know that the funds, so we know that the funds have to roll a position. They have to buy back their Novembers and move them into January. So who counteracts this? Who absorbs this? Well, as you get November trading at a premium, even money to some kind of premium to physical cash, well, you're going to probably bring in some interest from the sawmills that are going to potentially EFP down the road, or you're going to bring in liquidation as you have the convergence, where if I can go buy the physical cash, even money, or at a discount to my futures, then I'm going to unwind the trade.
Right, and you're getting to the time of the year where you can store wood without having any deterioration on it.
Yeah, yep. And so from a basis standpoint, you can see
jump back to the new contract.
Yep.
I look at this and I consider where we've just been, and you've got a $41 difference here from November all the way out to September, right? For the actual consumer of the wood, that's no big deal. That is not going to make or break a project. So, I think that you're going to see a significant amount of forward type purchasing and long-term purchasing, set prices. None of this contract based off of a survey, because they don't want to mess around. These guys are developers. You know what they have? They have the opportunity right now to build a multifamily project and have a great rental stream come in. What they don't want to do is screw it up by messing around with their cost. So to me, it seems so logical that if I can cover my need at, not even 5% over today's price for July, that's just an absolute no-brainer.
Yeah, no, all great points, Mike. I completely agree, and I'd rather tether myself to something like the new contract futures curve, price curve, versus, like you said, an index that when you ask 2/3 of the people out there, does that represent your reality? The answer is always a resounding no. So from a basis standpoint, a week ago, with cash coming down now, futures rallying up off of its lows. The basis a week ago, futures was trading $73. November was trading $73 under cash. Again, this is November as of yesterday's close. You can make the case that, again, based upon the reality of where cash is actually trading, not necessarily what print is going to reflect, but where cash is physically trading on Western SPF, Eastern SPF 2x4s, where November got up to today, where you've had the convergence with cash coming off and futures rallying to where, this is probably closer to $20, even money to $20, $25 versus that $70 a week ago. So, and that's the other reason why you've stalled out with that kind of unrelenting move lower in futures. You've gotten to too big of a discount to cash where you're going to buy the cheapest wood out there. And that's what you've seen kind of from a commercial standpoint with November trading down into that 402 area, 412 area, 420 area. You're definitely getting more interest to just cover. And then again, you'll sit there and wait for the convergence between cash and futures.
Yep.
There's January. And then from an open interest standpoint, the one thing that stands out this week versus last week. So last week, open interest is 25.29. This week, you're just under 3,000. When you take into consideration the new mini contract, total open interest for both mini and legacies over 3,000 now. And I would have to think this build in open interest, a lot of this is probably those NovJan spreads in anticipation of the fund rolls, more so than just outright positions. Who knows? Maybe we'll see another big increase with the commodity fund shorts, but I think a lot of this new open interest now is in the form of spreads.
Well, my wishful thinking is that it's folks actually hedging their exposure on projects.
Yeah, no, absolutely. We talked about the CFTC numbers. Again, mini, where this gradual build continues on. You can see that we've got 36 in March now. A week and a half ago, this was about 100 to 126. So that slow build continues on. And you're definitely seeing more interest to trade these back months, and you're definitely seeing it more from the end user segment that either supplies home builder direct or actual home builder multifamily, where there's interest to scale down by these back months, which is encouraging. You're getting a whole new segment of traders engaged in the mini contract, and that'll continue as we, again, get closer and closer to the end of this year into next year and that sunset date. The last thing I thought was interesting, when we talk about freight and shipping, either rail or containers. So the headline was cargo ship owners cancel sailing as global trade flips back from backlogs to empty containers. And you can see this. This is from a big freight analyst. It's pretty interesting how, kind of look at demand, kind of how this is starting to shift where capacity versus demand. You went from this massive demand, not enough containers, ships stuck on the water, just not enough open containers out there, to just the opposite now as demand kind of plummets globally all over the place. So what I guess where I'm going with this with rail, what I've started to see now, kind of in talking to the different sawmills out there, especially in the West, instead of, we've consistently been seeing rail car allocation in that 50, 60, 70% area. I'm seeing certain sawmills now in the West getting 100%, 110% rail car allocation, where they're actually getting extra empty cars now. Instead of not being able to ship everything, you're seeing the availability to ship 100% plus now.
Got it.
And so here's Canada. You can see this is trending in the right, and even with the U.S. now after the strike, this is your strike, or the impending strike. You're starting to normalize there as well.
All right, so let's wrap it up. Look, here's what I see. Freight's not really an issue. It's by no means frictionless, but it is less friction. Strong dollar. That's what I'm hanging my hat on. As long as the dollar stays strong, the U.S. is going to import deflation or export inflation. And I'm continued to be blown away by the Commitment of Traders report. We talked about this early on in our shows. Looking at market structure is so important. And that's the real tea leaves. When you can start to overlay your technical analysis with market structure, with where you are, seasonality, and then the overall position of the market, you start to put all those factors together. And are we going lower right now? Well, big picture, we're kind of gliding lower, but man, I tell you, it seems like we're on a powder keg here. You know, something could change, and the change is going to drive prices higher.
Yeah,
But if nothing changes, we continue to glide lower.
Yeah, and I think that's perfectly said, Mike. Extraneously, you have to watch the U.S. dollar. You have to watch the interest rate structure. Those could be kind of the big picture changing moments for the funds. But ultimately, for this thing to explode higher, I do think that's commodity fund driven more so than industry driven, unless you get this collective shutdown mentality from all sawmills, not just 1, 2, 3. You really need to see a significant change to the supply dynamic to mesh up with the current demand. Again, I'll say this again, demand will not be the savior. So if the industry doesn't like these prices, then it's up to the producers to do something about it. If that's not the case, then you're going to be watching for these other events like interest rates and the dollar as the changing moments to drive the funds out. If not, the funds are just simply going to roll and keep this going.
Yep. One thing we do know, multifamily projects are not being put on hold because of material prices.
No.
In fact, they're hitting the gas pedal, and it wouldn't surprise me to see some of that labor force moving from single family building to multifamily building. That's what the overall economy wants right now, more multifamily. So, all right, let's wrap it up. Thanks, Greg. As always, fantastic information.
Thanks, I appreciate it.
We'll see everybody next Tuesday. And in the meantime, safe trading and safe travels if you're going anywhere. Talk to you soon.
Thanks a lot, Mike. Good seeing everybody. Thanks.